Good evening, everyone. Welcome back to our online sessions on financial management. In the previous class, we have discussed certain ratios and also did a few questions from the module. Now, in this session, it's a sort of revision session that we have now. So this is going to be like a discussion about some more questions on the ratio analysis. So what I'll be doing today is initially I'll take up questions from my own end. Okay, I'll put up certain questions on screen and then we'll be solving it simultaneously. Meanwhile, I would request all of you to put up the module practice problems which you want me to solve for you. Wherever you find the difficulty things, I'll surely addressing the same. Moreover, I'll be first solving a question from my end, and then we will go for the questions which you will be putting up on the chat box, right? So I'll pick up those practice problems, and then we'll take up some more questions from my end onwards. Okay, I hope the things are pretty clear as to what is the agenda or what is the discussion going to be for today, right? So I request all of you to just put up the questions on the chat box so that I can, once I complete the first question, I'll go back to the chat box and I'll check as to where we need to look into or which are the questions that we need to look into, right? So right now, we'll take up this question, the first question that I've put up on the screen. If you guys want, you can just take a screenshot of it so that you can refer it back again and again, right? And meanwhile, I'll start solving this, and after the completion of this this question, I'll take up the practical problems which you will be highlighting. Okay, guys. So let's look at this typical question. Okay. Take a screenshot of it if you wish to take it. It will be there on the front, but still, I just wanted to the things should be clear enough. Okay, fine. I hope you would have taken a screenshot of it. We can first read out the question, then go for the solution of the same. Based on the following information, we have to prepare balance sheet of Stellar Limited as at 31st December. Current ratio is 2.5, liquidity ratio is 1.5, net working capital is 6 lakh, stock turnover ratio is 5, gross profit to sales ratio is 20%, COGS to net fixed assets, that's 2, average debtors collection period is 2.4 months, and fixed asset to net worth is 0.8. Long-term debt to capital and reserves is, the ratio is 7/25. These are the some ratios which are given to us. We need to calculate the prepare the balance sheet in a summary format. Okay, so let's begin, guys. First and foremost, the ratio that has been given to us is the current ratio. We've been given the current ratio, and that's 2.5. Now, if you look at which is the next number which I should use along with current ratio, that has to be definitely net working capital of 6 lakh, right? So current ratio of 2.5 and a net working capital of 6 lakh. That is what we need to work out with, right? So let's go ahead with the first question. We have been given the information about current ratio. Current ratio is 2.5. Therefore, can I say current asset upon current liability is 2.5, which means current asset is 2.5 times of current liability. Right? So current asset is basically 2.5 times of the current liability, making this as equation number 1 maybe for that case. And we also know, since the net working capital is rupees 6 lakh. Now we know that this net working capital of 6 lakh, that's actually current asset minus current liability is 6 lakh. Current asset minus current liability is actually 6 lakh. But here we know that current asset is actually 2.5 times of current liability. So we'll say from 1, current asset can be written as 2.5 times of current liability minus current liability, that's equal to 6 lakh. So therefore, now this works out to be like 1.5 times of current liability is 6 lakh. So current liability stands as 6 lakh divided by 1.5. What are the queries? Sir, we are not able to see Paper-8A class on app. Still app is showing morning class. Is this an issue? Students are not able to see the class on the app. Is there an issue? Hmm? And just put a message. Okay, I think you should be able to see it on YouTube, so I'm just continuing from there. You can just check the lecture from YouTube and you can reply from the app. Okay, I've escalated it to the tech guys. They'll surely get it done. Right now you can just access it from the YouTube. Now, let me just continue with this. So we said current asset is 2.5 times of the current liability. So by substituting, we get The current liability figure 6 lakh divided by 1.5. That's like 4 lakh. Current liability is 6 lakh divided by 1.5, 4 lakh. Now, after this, once we get the current liability, definitely we can also say our current asset is 2.5 times of current liability, which is 2.5 times of 4 lakh, right? So that's like 2.5 times, it works out to be 10 lakh. Okay, so we get a current asset figure of 10 lakh. Fine. So we have used the current asset, net working capital, and the other thing, net working capital, and the current ratio is used. Now, let's go for the next ratio to be used. See, so liquidity ratio and the net working capital information is used by us. Okay. Liquidity ratio of 1.5 is the next one that we have to use. Now we say, since liquidity ratio is 1.5. Yes, your chat is visible. Who is this? I think Kshitij. No, Kshitij not. Abhijit. Abhijit, your chat is visible. Liquidity ratio of 1.5. So we know liquidity ratio stands as liquid assets, and that liquid asset is basically current asset minus your stock. Current asset minus stock upon current liability is 1.5. Now the thing is, we already know what is our current liability, what is our current asset. By default, we can get the balancing stock figure. So current asset of 10 lakh minus stock of, we don't know what's the stock, sir, divided by current liability. Sir, current liability also we know, which is 4 lakh. That's equal to 1.5. So 10 lakh minus stock is 1.5 times of 4 lakh. 1.5 times is definitely 6 lakh. Therefore, stock should be amounting to 4 lakh. Good. We got the stock value also as 4 lakh. Okay. So we use the liquidity ratio now. Now the next number is stock turnover ratio. We have to use this stock turnover ratio, GP, and all these figures. Stock turnover ratio, as we have learned, stock turnover ratio, we had the formula for stock turnover as what? COGS, cost of goods sold, divided by average stock. Now there is no information about opening stock, right? So there's no information about opening stock. So we'll assume that whatever is our closing stock, that itself is the average stock. And the stock turnover ratio is 5 times. This is 5. So COGS divided by the stock of 4 lakh, the same stock of 4 lakh is taken over here. That gives us 5. COGS therefore amounts to 20 lakhs. COGS is cost of goods sold is 20 lakhs. Now if our COGS is 20 lakhs, and remember they have given us the GP ratio to be 20%. GP ratio to be 20%. So sir, if GP ratio is 20%, we can say since GP ratio is 20%, is the GP ratio is 20%. Therefore, can I say our COGS ratio will be 80%, because we have discussed it in those ratios that these two ratios are complementary to each other. And since our COGS ratio is calculated as what? So it is COGS divided by sales into 100. So our COGS ratio is given to us to be 80. COGS ratio is given as 80. That's equal to COGS amount that we have computed, 20 lakhs. COGS of 20 lakhs divided by sales into 100. So this should give us the amount of sales. So sales will be 20 lakh divided by 80 into 100. Therefore, sales will be 20 lakh divided by 80 into 100, which is 25 lakh. We get a sales figure as 25 lakh. I think some guys have joined late. So I just want to tell you, wherever in the module practice problems you have any issues, or for that case any RTP question, any past exam question paper, if you have any doubts, you can just put it in our chat box in your app. I'll take up the questions and discuss them in this session, because this session is anyways primarily for the revision purpose. So all your doubts or all your any questions which you have got a bit of tricky or somewhere you're getting stuck, just give the reference of that question in the chat box. I'll take it up once I complete this first question. Okay guys, fine. So I just thought some of you might have joined late, so just repeated the announcement that I made at the very start. Okay, so here we have the sales figure, we have the COGS figures. Now stock turnover is used, GP ratio is also used, gross profit ratio. Now we have this COGS to net fixed assets. Okay, cost of goods sold upon fixed assets. Cost of goods sold upon fixed assets, that's given as 2. COGS to fixed asset is given as 2, twice of it. So fixed COGS is twice of fixed asset, that's the ratio. But now the thing is, sir, we have the COGS figure. Cost of goods sold figure is 20 lakh. So if the cost of goods sold figure is 20 lakhs, cost of goods sold figure is 20 lakhs upon fixed asset is 2. So we can say that our fixed asset is 10 lakh. Correct. We get the fixed asset figure to be 10 lakh. Next. So we use this ratio also. Next is average debtors collection period is 2.4 months. Okay. So we are having the debtors collection period. Debtors collection period is given to us to be 2.4 months. We know, sir, debtors collection period is computed as 12 months divided by debtors turnover ratio. Now that itself means it is 12 months divided by debtors turnover is what? it is credit sales, or let's consider all the sales to be on credit. That's like divide by sales upon debtors, that's 2.4. So simplifying this further, we can say that 12 by 2.4 is basically sales by debtors. So 12 divided by 2.5, sorry, 12 divided by 2.4, that's 5. So 5 is actually sales divided by debtors, and we know that the sales figure is 25 lakh. So sales is 25 lakh divided by debtors. Therefore, the debtors value will be 25 lakh divided by 5, which is 5 lakh. Okay, so we got the debtors value to be 5 lakh. Right, guys? Great. So this is, the next part is also done, which is we use the average debtors collection period. Now, next thing is we have to use fixed asset to net worth. Fixed asset to net worth. Fixed asset to net worth. This ratio is given to be fixed asset to net worth as 0.8. Fixed asset to net worth is 0.8. So fixed asset is, anyways, we have computed it to be 10 lakh. So fixed asset is 10 lakh divided by net worth. We don't know what's the net worth. That's 0.8. Therefore, there is 10 lakh divided by 0.8 is net worth. So sir, what about the net worth? So the net worth will be 10 lakh divided by 0.8, that's 12 lakh 50,000. So we get the net worth figure to be 12.5 lakh. Okay, that's great. Fixed asset to net worth is used, guys. Now only the last ratio is pending, which is long-term debt to capital and reserves. Long-term debt to capital and reserves. So it is like long-term debt upon capital plus reserves, that is given to be 7 by 25. That's given to be 7 by 25. So long-term debt is, we don't know, sir. So capital and reserves, we know it is 12 lakh 50,000. So this itself is capital plus reserves. Long-term debt upon 12 lakh 50,000 is 7 by 25. Therefore, our long-term debt will stand as, we just need to multiply 12 lakh 50 with this. 12 lakh 50 into 7 divided by 25, that's 3 lakh 50,000. Long-term debt is 3 lakh 50,000. So we have used all the ratios and got a lot of values over here. Now we have to give the final shape to the balance sheet. So let's prepare the draft balance sheet. Okay. In the balance sheet, we have got first up the net worth of 12 lakh 50,000, which is a share capital and reserves. Now we don't have the bifurcation between share capital and reserves, and no information is given in the question also for that. So under that scenario, we are going to just put up it as a net worth only. net worth is 12,50,000. Then we have long-term debt, which is 3,50,000, right? Then fixed asset of 10 lakh, right? Fixed asset of 10 lakh. We had the current asset total to be 10 lakh. So current assets, it was totaling to 10 lakh. And if I just deep dive into what is there in the current asset, we have identified that the current asset consists of stock, debtors. How much was the stock that we computed? Remember, stock was 4 lakh. Debtors was 5 lakh. Stock is 4 lakh. Debtors is 5 lakh. Cash bank balance. This is the right. Coming on the other side, if you look at the current liability, we just had a total of current liability to be 4 lakh. No further bifurcation or any such distribution about from where this 4 lakh is coming. So on the liability side, we have only one figure, current liability, and that current liability is 4 lakh. So if we look at what amount is our balance sheet getting tallied, sir, balance sheet is like, this is 20 lakh, this is also 20 lakh. So balance sheet tallies at 20 lakh guys. I hope you guys have also got the same answer or maybe a similar answer. Pretty easy question. Right? Now, I can find some of you have put up the practical questions to be taken up. Please take practical question 3. Okay. MCQ number 14. Okay. So 2 requests have been placed right now. One is the practical question number 3 and the MCQ number 14. I'll proceed with these 2 questions. Meanwhile, others can also put up the questions which they want to ask or wherever they have the doubts. I'll take up the question from over here. Okay, this one. MCQ number 14 and practical question 3. Okay, guys. Let me take up MCQ number 14. Okay. There it is. MCQ number 14. Fine. Let's look at it. What are the numbers given to us? Calculate the operating expenses from the information given below. We have a sales of 75 lakh. Income tax is 50%. Net profit to sales figure is 5%. Cost of goods sold is 32 lakh 90. Interest on debentures is 60 lakhs. Okay, we want to know what is our operating expenses. So let's prepare the somewhat like this. We'll start with sales with an amount of 75 lakh. From that, we know we subtract the COGS, which is 32 lakh 90,000, right? So after subtracting that COGS, you should get gross profit. So that gross profit will be 75 lakh minus 32 lakh 90,000, which is 42 lakh 10,000. Rate of income tax is given, net profit to sales figure is given, interest on debentures is also given. So from GP, we subtract our operating expenses. Okay, after subtracting the operating expense, we get actually the earnings before interest and tax. Earnings before interest and tax, we have no idea, sir, what is that earnings before interest and tax. From that, we basically subtract the interest. Now that interest is already given to us to be 60,000. That's the 60,000, right? Interest is 60,000. From that, we actually get profit before tax. After payment of tax, we have a profit after tax. Now, the question is saying that there is 5% net profit on sales. So obviously, 5% of 75 lakh is going to be PAT. So 75 lakh into 5%. So our PAT is 3,75,000. Right. So PAT is 3,75,000. Now, if the tax rate, that's the tax rate of 50%. So if the tax rate is 50%, it means if your PBT is 100, tax is 50, PAT is 50. So going, undertaking a backward calculation like this, we can say that 3,75,000 is the PAT, and that same 3,75,000 will be the tax figure, and our PAT is going to be like 7,50,000. PAT is PBT, sorry, profit before taxes, 7,50,000. Okay, so PBT 7,50,000, we have an interest of 60,000. So, but obvious, sir, if this is 60, how much will be EBIT? We just need to backward calculate it, which is 8,10,000. Right? Now, this 8,10,000 EBIT, again, we need to do a bit of backward calculation and maybe find out what is the gap over here, balancing figure. So you can say it is 8,10,000 minus maybe 42,10,000. That's 34 lakh. 34 lakh should be your operating expense. 34 lakh should be your operating expense. I think answer C. Correct answer for this is C. Yeah, 14. Correct answer is C. So MCQ number 14, as requested by you guys, it's solved. Next is practical question number 3. Practical question number 3. I think this is what we have done in the previous class. Right, guys? Practical question 3 has been solved by me in the previous class as far as I remember. Fixed asset was given of 26 lakh and catching hold of that we have solved everything. Yeah, that's done, guys. Practical question 3 is done. Any other question, guys? Practical questions, or shall I take up my own questions then? Any other practical question you have any doubt, or any RTP question or any past questions that you might have seen? I have shortlisted few questions. So we'll be doing that in the today's session. But apart from that, if you have got any doubts, we can surely entertain that. As of now, I don't find any questions from your end in the chat box. So let me proceed with the next question. After that is done, then we will think of taking up your questions accordingly. Okay, guys. Acha. One thing, this entire PDF containing all my handwritten notes, all the solutions will be uploaded on the portal once I complete today's session, so that the entire handout, entire booklet is with you for the ratio analysis part and also the questions that I'm solving today. Okay, fine guys, let's then go for the next question. Okay, so there's a request. Please explain practice question 5. Okay, fine guys. Practice question number 5. Practice problem 5. Okay, fine. I'll solve this for you. Use the following information, prepare the balance sheet. So what information is given to us? They have told us what is long-term debt to net worth, that's 0.5. Total asset turnover ratio is 2.5. Average collection period is 18 days. And you'll find that there's an asterisk over here that indicates that we have to assume 360 days and all the sales are on credit. Inventory turnover is given. Gross profit margin is given. Acid test ratio. Hey, what is this acid test ratio? Is this some scientific test? No, we know this is the quick ratio, right? Acid test is nothing but the quick ratio. And we have to complete this balance sheet. Fine. Let's go ahead and solve this, guys. Question number 5. Practical question number 5. The first ratio that we have is long-term debt to net worth. So long-term debt to net worth. Long-term debt to net worth is 0.5. But the thing is, sir, over here, I don't know what is the long-term debt. But net worth, yes, I know, sir. We have common stock and the retained earnings. Right? So this is like long-term debt upon net worth is basically common stock of 1 lakh plus retained earnings of 1 lakh. So that ratio is, sir, 0.5. So we can say long-term debt upon is 1 lakh plus 1 lakh, that's 2 lakh. This is equal to 0.5. Therefore, long-term debt will be 1 lakh. Okay. Because this value long-term debt is 1 lakh. Long-term debt is 1 lakh. Now, going for the next use, total asset turnover is 2.5. Now, what is a total asset? So, total asset will be total of all these 4 items. Right? Total asset will be total of all these 4 items, which is total assets. And we know as a basic fundamental rule, total asset should be equal to total liability. Right? So, we say since total assets is equal to total liabilities. Now, of course, total liabilities means we have got a notes payable of 1 lakh, long-term debt of 1 lakh, common stock of 1 lakh, retained earnings of 1 lakh. So total assets turns out to be 4 lakh. And we have the total asset turnover ratio. So total asset turnover is basically sales divided by total assets. Sales divided by total assets. So total asset turnover is given to us to be 2.5 times. That's 2.5 is equal to sales divided by total assets of 4 lakh. That will help us to be like sales should be equal to 4 lakh into 2.5, which is like 10 lakh. So the sales figure is 10 lakh. Okay, sales is 10 lakh guys. Okay, this is done. Sales is done. Then based on that sales figure, we are going to help out with this average collection period. So sir, average collection period is 18 days. Average collection period is 18 days. Since average collection period is 18 days. Sir, how do we compute this average collection period? We compute it as sales divided by the debtors. No sir, that's the debtors turnover. Average collection period is 360 days we have to assume, right? In the question stated, we have to assume 360 days. 360 days divided by debtors turnover, that's 18. So sir, 360 divided by the debtors turnover is what? Sales upon debtors is 18. Therefore 360 by 18 is sales by debtors. So do we have any sales figure? Yes, sales figure. Just computed it to be 10 lakh. So 360 divided by 18, sir, how much is it? It's 20. That's like the sales figure of 10 lakh divided by debtors. So our debtors should be how much? That's 10 lakh divided by 20. Therefore, the debtors should be 50,000. Right. So from this we can get accounts receivable or debtors to be 50,000. So we got this. So average collection period is used. Now we have to use the inventory turnover ratio. Let's look at the inventory turnover ratio. Okay, yes. Inventory turnover ratio is computed as COGS upon inventory or average inventory. No information about opening, so whatever is the closing, that itself is our average inventory, right? So inventory turnover ratio is 9 times. Sir, I don't have COGS. What should I do? Okay, if you don't have COGS, take help of the next ratio, which is GP margin of 10%. So remember guys, if GP ratio is 10%, then What will be the COGS ratio? If GP ratio is 10%, COGS ratio will be 90%, right? So COGS is going to be 90% of sales upon inventory is equal to 9. So 90% of sales upon inventory is 9. So this is like, sir, 90% of sales. What is the sales figure? Sales figure is 10 lakh. So this is 90% of 10 lakh upon inventory is 9, which means 9 lakh upon inventory is 9. So from this we can say that our inventory is 1 lakh. Right? So inventory is 1 lakh. Inventory turnover, inventory is 1 lakh. GP margin is used. Now only one thing is pending, so that is acid test ratio. Acid test ratio, we know it's the simple part, which is about the quick ratio. So now you have to use this quick ratio. Remember, we have got the long-term debt, we have got the inventory value also 1 lakh. We know what total asset is. We know what is the amount of debtors is. So we just need, the cash and the plant and equipment. So for that we will take the help of acid test ratio. What's the formula for acid test ratio, guys? Acid test ratio, we know it is current asset. So there is no information about current asset in the question. Okay, so based on these figures that it has got cash, accounts receivable, inventory and plant and equipment, what will be the acid test ratio numerator? The numerator of acid test ratio, it has to be, sir, debtors plus cash upon current liability, and this ratio is given to us to be 1. Debtors plus cash upon current liability is given us to be 1. So debtors, we know it is 50,000, sir. So debtors is 50,000 plus, what is the amount of current liability? Current liability is notes and payables is 1 lakh. So divide this by 1 lakh. Plus you add cash to it so that you get 1. And then we say 50,000 plus cash is equal to 1 lakh. Therefore, cash balance will be 50,000. We get the value of cash also. Now, it's time for us to prepare the balance sheet, the final balance sheet. Okay. Let's prepare it, guys, the final balance sheet. Equity share capital, retained earnings, long-term debt. I'm just writing a shortcut. Don't do the same in the exam. You need to write the full form. And then the current liabilities. And on the asset side, we have got cash, accounts receivable, plant and machinery, inventory, receivables, and cash. Okay, so let's fill these values, guys. Let's fill these values, guys. We have got a cash that we observe over here, 50,000. We find that inventory is 1 lakh, right? Then after that we have got debtors of 50,000 or the receivables to the tune of 50,000. We have certain values from the question also, like we've got the current liabilities or the notes and payable to be 1 lakh. Long-term debt we computed it to be 1 lakh. Retained earnings is also 1 lakh, and equity share capital is also 1 lakh. This totals up to 4 lakh. This totals up to 4 lakh. Now by default, we can say what's the total of both the sides. Of course, 4 lakh. So plant and machinery is definitely a balancing figure of 2 lakh. Okay. Fine. Will you taking the query from chapter 1? Yes, definitely. Please take MCQ number 6 of chapter 1. Okay, surely. MCQ number 6 of chapter 1. What's there in this MCQ number 6? Which of the following is not a control of financial management? Not an element of financial management. Okay. Yeah. Which of the following is not an element of financial management? It is not an element. So if it's not an element, it'll be like, of course, allocation of resources is a part of our thing. Financial planning is a part of our discussion. Financial decision making is yes. It's not financial control. Financial management is not about financial control, that is cost control sort of thing. So the element of financial management is allocation of resources, making planning, and then deciding how to allocate the resources. Right? So controlling the finances, that's not a part of financial management. But basically, when you say financial control, it's actually the cost control part. Okay. Fine, sir. Any other queries, guys? Any other queries? Or shall we go for the next question which I have for you? Any queries, guys, you've got? If any, just try to put it in the due course. I'll straight away go ahead with question number 2 now. That's the practice question which I have drafted for you. Question number 2. Okay, yes it is. Let me start with question 2. You may put up your queries on the chat box accordingly. Okay, question 2. From the following information and ratios, prepare a statement of profit and loss and balance sheet. Assume 1 year as 360 days. Ignore taxation. From the following information and ratios, prepare a statement of profit and loss and Balance sheet assume 1 year as 360 days, ignoring the taxation. Current asset to stock ratio is 3.3:2. Current ratio है 3. Asset test ratio है 1. EBIT to PBT is 2.2. Then earnings per share is given to be 10. Book value per share is 40. Average collection period is 30 days. Fixed asset turnover ratio is 1.2. Total liabilities to net worth is 2.7. Net working capital of 10 lakhs. Net profit to sales is 10%. Variable cost to sales is 60%. Long-term loan interest is 12% and stock turnover is 5. So just have a brief look at it. Just have a brief look at it. And then we'll start with the solution for the same. Okay, fine. Okay, you want to take a screenshot, right? Yeah. You can take a screenshot of this question too if you wish to. And then we can look at its solution. Okay, fine. Let's begin, guys. So first and foremost, the number that we have is current asset to stock of 3:2. And in that also we have like current ratio of 3. This is again a ratio. As I told you, whenever there's a question that you have ratio, you cannot start with the solution. You need to look at some absolute number wala data, right? So with this regards, the current ratio of 3, against it you can find that there's a net working capital of 10 lakhs. We have a net working capital of 10 lakh, which I can connect it with my current ratio. So that's the first and foremost step to start the solution. So we take help of, since current ratio is 3:1, therefore current asset upon current liability is 3. Therefore current asset is 3 times of current liability. Right, so current asset is 3 times of current liability. That's our equation number 1. And then we use the net working capital. Net working capital is 10 lakhs. Net working capital is 10 lakhs. Therefore, sir, current asset minus current liability is 10 lakh. Current asset minus current liability is 10 lakh. And therefore, current asset, we know this current asset to current liability. This number is given. So in place of current asset, we can place 3 current liabilities. Minus current liability is 10 lakh. Therefore, 2 times of current liability is 10 lakh. And we get a current liability of 5 lakh. Right? Now, once we get this current liability of 5 lakh, definitely, sir, current asset is going to be 3 times of current liability, which is like current asset is 3 times of 5 lakh. Therefore, current asset is 15 lakh. Done? Fine. So we have utilized this ratio and also the net working capital. Now, the current ratio we have used, right? The current ratio. Now let's look for this current asset to stock ratio. The current asset to stock ratio is given to us. Current asset upon stock ratio is given to us to be 3:2. If that's 3:2, current asset we got 15 lakh upon a stock. That's 3:2. Therefore, stock will be how much? Stock will be 15 lakh into 2 by 3. Stock will be 15 lakh into 2 by 3. Therefore, stock will be 10 lakh. Right? Sure. We use this current asset to stock ratio also. Now the next one is acid test ratio of 1. What is acid test ratio of 1? So let's apply that. Acid test ratio to be 1. And in the question, you don't have any information about short-term short-term investments or liquid assets or money assets, nothing given. So acid test ratio, it should be simply like, considering after subtraction of this 10 lakh, it's just like a confirmation thing. You can just verify it. It's like current asset minus stock upon current liability should be 1. So current asset of 15 lakh minus stock of 10 lakh upon current liability of 5 lakh. That is absolutely matching. So this is like confirmed, sir. This is a thing which is surely confirmed. Okay, then that's the thing. Asset test ratio. Then next is EBIT to PBT. Again, it's of no use to us because we don't know EBIT, we don't know PBT, so we can't calculate anything. EPS is 10. Okay, book value per share is 40. Now this is going to be a really important number for us. Okay, so just keep in mind average collection period is 30. So for that, we'll have to take help of the turnover for that case. Fixed asset turnover, again, we don't have fixed asset, neither the turnover. Total liabilities to net worth, again, it's something, dicey, we don't know where it is. Stock turnover, so all these things are now, in a situation that we can't calculate anything unless and until we get some of the other value. Right? So, we have like net profit to sales figure, okay, variable cost, okay, long-term loan interest, again, that's the interest cost. So any of these values are not sufficient to get the answer. Right? So from here you can say statement of P&L balance sheet. There's no information about the shares or anything like that. So now we'll have to prepare a draft balance sheet first, and then we will be able to proceed accordingly. So we'll have a draft balance sheet and a draft P&L. Okay, I am preparing P&L in this vertical format because it talks of variable cost and all such stuff. Okay, so now over here we have got like a current asset of 15, current liability of 5 lakh. Okay, so current asset is 15 lakhs, current liability is of 5 lakh. And in that current asset also, we have information about stock. We have the information about stock. So that stock is like what, 10 lakh. The rest 5 lakh, we don't know whether it is debtors or whether it is cash in bank, but surely there will be debtors because we have the information over here. Debtors, that is, we have this average collection period. So from there, we are definitely going to get the amount of debtors, and the balance, if any, will be cash or bank, which we will compute later on. So as of now, we have this information: stock, current liability, and current asset. Now we'll talk of the draft P&L also. In the draft P&L, we'll definitely have sales figure, which is not given to us, no information of sales. From that, we subtract the variable cost. Again, we don't have any information about the variable cost. So we know that sales, if it is 100, variable cost is 60. And after subtracting the variable cost, we know we get contribution. We get a contribution, which again we don't know. Then after contribution, we need to subtract the fixed cost, which again we have no information about fixed cost. So we get this earnings before interest and tax. We get this earnings before interest and tax, which again no information available. From that, we subtract the interest. The interest amount, if you look over here, that's given to us. Long-term loan interest rate is 5%. Again, we don't know what is the long-term loan amount. So we are stuck. Never mind. From interest, we will get profit before tax. In fact, question says you need to ignore taxation. So if you need to ignore taxation, of course, your profit before tax and profit after tax is just one and the same. It's just one and the same. Now, they have given that net profit to sales is 10%. Net profit to sales is 10%. Again, net profit to sales, we don't have information about sales or anything. So how do we go about now the other things? How shall we go about it? Because we are now somewhere like in a situation, we are stuck, sir. We don't know how do we go about the other things. Because if you look at any other number like total liabilities to net worth, it's of no use, because unless and until I have the total of liabilities, how will I get the net worth? Right? So total liabilities to net worth 2.75, book value per share, leave it. Average collection period is 30 days. For that we need the debtors. Fixed asset turnover 1.2. It's all stuck up maybe. If you just think it a bit different, total liabilities to net worth is 2.75. Now, over on this side, we might be having long-term loan, and there will be net worth. Now, the ratio which they have given, total liabilities to net worth, total of liabilities to net worth. So we don't know this long-term loan, so how will I go about with this? EPS is 10. So if EPS is 10, this means like this is a figure which we would be arriving at by dividing this with the number of equity shares, which again we don't know. that should be giving me a EPS. So we have just a EPS figure of 10. Just a EPS figure of 10. We got just a EPS figure of 10. So EPS is of 10. Book value per share. This should be like net worth divided by number of shares. No such information. Average collection period is 30 days. Unless and until debtors or sales, it's of no use. For fixed asset turnover, also on the similar lines. Then net profit to sales 10%, long-term interest rate, variable cost, stock turnover is 5. Is this of any use? Yes, sir, it seems to be, because for stock turnover will take the COGS, right? Since stock turnover is given to be 5. So how do we get the stock turnover number? Stock turnover is basically cost of goods sold. Stock turnover is cost of goods sold divided by stock is 5. Now you might be in a position to be getting a bit of relief that possibly, sir, we are trying to get an answer. So COGS upon stock is 5. Therefore, COGS will be 5 multiplied by 10 lakh. So cost of goods sold should be ideally 5 multiplied by 10 lakhs, because 10 lakh was the stock. COGS is possibly, sir, 50 lakhs. Now what will be this COGS figure? If COGS is 50 lakh, what will be this figure, COGS? Is it going to be like the variable cost and fixed cost? If I sum up, what will be the scenario? If you take this, both of them together to be 50 lakhs, still it won't be of much use. And here we can safely assume for this question, because there's no way out, there's no information about fixed cost in the question also. So in the fixed cost, you will find that there's no information about the fixed to sales ratio. So we can safely assume that this COGS is variable cost in nature. That's like variable cost in nature. So if we have to assume that, because if you just scan through the question, EBIT to PBT is given as 2:2.2. Book value, average collection, fixed asset turnover, total liabilities, variable cost to sales, long term, and everything. There's no other proper way to look at it. So we'll have to assume that whatever is the COGS we are having, that is variable cost in nature. So if that's variable cost, we can say, therefore, variable cost is 50 lakh. That's actually 60% of sales. Therefore, sales figure is going to be 50 lakh into 100 divided by 60. So if let's check it out, that should be this number, 50 lakh into 100 divided by 60. The sales is, sir, 83 lakh 33,333. Sales is 83 lakh 33,333. And our COGS is 50 lakh. That will give me a contribution of 33 lakh. The question is silent about fixed cost. So let us keep it a silent or no fixed cost. Now, so definitely my EBIT is same 33 lakh. From that, I need to reduce the interest to get the profit before tax and profit after tax. For that, we will use this ratio, PBT to or EBIT to PBT. We will say since EBIT to PBT, earnings before interest and tax to PBT, is 2.2. Therefore, EBIT is 33,33,333. 33,33,333 upon PBT is 2.2. Therefore, profit before tax will be this divided by 2.2, which is 33,33,333.33333 divided by 2.2. Yeah. PBT is 15,15,151. Lakh 15,151, and accordingly the interest will be the difference between these two, which is 18,18,181 or 182 for that matter. Okay, there's some there's something left out over here. Wait guys. Once we have got the sales figure, my profit that is given, net profit to sales is basically 10%. Therefore, net profit is 10%. So 10% of this I need to take up. So 10% of this. So my profit will be 10% of sales actually. So 10% of sales will be like 8,33,333. Interest amount that's given to it 12% anyways. Now based on this number of PBT, I'll have to calculate this. There is an error over here guys. My bad. Yeah. So EBIT upon PBT is 2.2. So EBIT will be 2.2 multiplied by 8,33,333. So our EBIT will be 2.2 times of this, which is 18,33,333. That is 18,33,333. So the interest is basically 10 lakh. The difference between EBIT and PBT, and the difference between contribution and EBIT will be the fixed cost. Minus, which is 15 lakh. 15 lakh is the fixed cost. And if we look at the number of shares, that number of shares should be ideally, sir, 83,333. Right. So now, once we get these figures, now we can think of EPS of 10, book value per share is fine. Average collection, now fixed asset turnover. Now for that average collection period is anyways 30 days. So we'll use that number. Average collection is 30 days. So that 30 days should be we have to assume 360 days, right? Anyways, yeah. 360 divided by sales upon debtors. So 30 is 360 divided by sales is 83,33,000. Divided by debtors. So the debtors will be 83,33,333 into 30 by 360. So that's 83,33,333 into 30 divided by 360. That's 6,94,444. So we get the debtors value also as seems to be a is it 30 days? Yeah, average collection period is 30 days. So the debtors will be 83,33,333 into 30 by 360. We'll do one thing, guys. There is something error going on here. We'll take a break now. Okay, just take a break of 10 minutes. Post that, we will try to resolve this. Okay, let's take a break, guys. Tell you. Good to go? Am I online? Okay. Okay, welcome back guys after the break. There's a small thing in this question. Actually, the stock turnover ratio of 5, this is based on sales guys. So therefore we were actually somewhere not getting the matching values. Okay, so just take a note of it. This is based on sales. So if this is based on sales, guys, so we can simply say that it is not COGS, that's actually the sales figure in itself, and that actually renders all our calculations over here not required or incorrect, because that one thing was missing, which is stock turnover ratio. So it should be like sales to stock is 5. So definitely sir, sales figure is basically 50 lakh. Okay, so we have got the sales figure to be 50 lakh, and in fact all these numbers are also actually not much relevant. We need to rework them. Okay, fine. So sales is 5 lakh. So variable cost, definitely if it's 160, so 60 means that amounts to variable cost of 30 lakhs, and we have a contribution of 20 lakh. 50 lakh sales with a variable cost of 30 lakh, contribution is 20 lakhs. We don't know about the fixed cost, what it is. We even don't know about what is the EBIT. Interest is also something not known, but we know that profit before tax or PAT is 10% of sales. So 10% of sales means profit is actually 5 lakh, right? So once we have this 5 lakh, now we will take help of that ratio of EBIT to PBT. EBIT to PBT. So since EBIT upon profit before tax is 2.2, right? So EBIT will be actually 2.2 times of 5 lakh, right? Because PBT is 5 lakh. So our earnings before interest and tax is 2.2 into 5 lakh, 12 lakh 50,000. Right? So we get a EBIT of 12 lakh 50,000. So now that itself is going to help us in a great way, because once we get a EBIT of 12 lakh 50,000, but obvious the fixed costs will be the difference between these two, which is 7 lakh 50,000. Right, so contribution of 20 lakh reducing the 7 lakh 50,000 fixed cost, we get a EBIT of 12 lakh 50,000. From that 12 lakh 50,000 we subtract the interest. Interest we don't know, but we can again get this as a balancing figure between these two. The interest is actually 7 lakh 50,000, and they've given in the question that EPS or earnings per share is actually 10. So if earnings per share is 10, definitely your number of shares would be 50,000. Number of shares is 50,000. Okay, fine. Now from this we have to do all other sort of calculations. This 30 will be 360 divided by sales upon debtors. Sales is 50 lakh, so 50 lakh upon debtors. So we can say that the debtors value will be 50 lakh multiplied by 30 upon 360. Therefore, we get the debtors value to be 50 lakh into 30 divided by 360, which is 50 lakh into 30 divided by 360. So debtors is actually like a typical number, 4,16,667. Bit of imperfect number, which is fine. This is 4,16,667. Cash bank will be definitely the balancing one, because the total of current asset is 15 lakh. So the balancing one, 4,16,000, adjusting for that, 15 lakh minus 10 lakh minus 4,16,667. Cash or bank balance is 83,333. 83,333. EBIT is 11 lakh. What are you saying? $5 lakh into 2.2. Oh yeah. This EBIT is 11. 2.2 into 5 lakh, no? BAT upon PBT is 2, so this will be 11 lakh. Correct this. Oh, lot of errors. If EBIT is 11 lakh, then we will need to revise these figures also. Interest is means 6 lakh. Fixed cost will be 9 lakh. The debtors are not impacted because that's continuing to same. Current asset is there, current liabilities are there. This is filled up. Now let's look for the other ratios which we can use. We have utilized EBIT to PBT ratio. We have used EPS. Now book value per share is what we are going to use now. Book value per share. So book value per share is given as 40. So before that, book value per share, we can actually think of average collection period use. We can use this fixed asset turnover ratio of 1.2. Since fixed asset turnover is 1.2, so fixed asset turnover is sales upon fixed asset is 1.2. Sales figure is 50 lakh. Sales figure is 50 lakh upon fixed asset is 1.2. So ideally, sir, fixed asset will be 50 lakh divided by 1.2. 50 lakh divided by 1.2. 50 lakh divided by 1.2 is 41,66,667. That's the fixed asset which we get. Fixed asset based on the fixed asset turnover ratio. Fixed asset turnover ratio is used, so we get a fixed asset of 41,66,667. Over here, fixed asset is 41,66,667. Okay. Then, of course, the total of this will be our total of assets, 41,66,667 plus 15 lakh. That's 56,66,667. 56,66,667. Ideally, this also should be the same, right? The next thing will be about the long-term interest rate of 12%. Since long-term interest is 12%, so interest is basically 6 lakh, which should be 12% of long-term debt. 12% of long-term debt. So long-term debt will be 6 lakh divided by 12%. That's actually 6 lakh divided by 12%, which is long-term debt comes out to be 50 lakhs. As you've seen, the interest of 6 lakh, so long-term debt is 50 lakh. That's 12%. And then finally, we can have this balancing figure as 1,66,667, right? Yeah, but if you look at the other parameters, it is actually not tallying, because you'll find that if I take this as a balancing figure, that's actually not tallying, because there's another ratio called as total liabilities to net worth. Total liabilities to net worth, it doesn't seem to be 2.75. So we cannot take this as a balancing figure. In fact, there's a specific information given to us for net worth, and we definitely know that this is possibly not the total, because we might be having something else also, right? So, but we know that total liabilities to net worth is some ratio given to us. Total liabilities to net worth is given as 2.75. If you take 1,66,000 as a balancing figure, then this ratio doesn't match. This ratio doesn't match. Net worth, total liabilities to net worth should be 2.75. Now total liabilities will be net worth plus long-term debt plus current liability upon net worth of 2.75. We need to solve it further. So net worth plus long-term debt is 50 lakh plus current liability is 5 lakh. That's equal to 2.75 times of net worth. Then rearranging it, we get 1.75 times of net worth is equal to 55 lakhs. So how much is our net worth, sir? Net worth is 55 lakh. Divide by 1.75. One second, there is something error. There is some error. Wait. Get this as 50 lakh. Then we look at Yeah. So total liabilities to net worth is 2.75. So total liability should be this figure. Total liability should be net worth plus long-term debt plus current liability upon net worth. So we don't know what is the net worth plus long-term liability. That long-term debt we have taken it as 50 lakh and current liability is 5 lakh. Plus current liability of 5 lakh divided by net worth is 2.75. Oh wait, it's the total of liabilities. So if it's ideally liabilities, it should not include equity, because our net worth is never a part of our equity, right? So if it is total liabilities, it should include only long-term debt and current liability. It should not include the net worth, right? So divided by net worth. So we can say our net worth is 55 lakh divided by 2.75. So net worth is 55 lakh divided by 2.75, which is 20 lakh. Net worth is 20 lakh. Okay, so finally we're getting this as net worth is 20 lakh. Just check out if there's any other ratio left out. We have used average collection period. Total liabilities net worth is used. This is used, this is used, this is, all the ratios are used. The only thing is that with regards to equity capital, they're saying book value per share is 40, which definitely tallies because we said number of shares is 50,000 and the net worth is 20 lakh. So 20 lakh divided by 50,000, that definitely tallies to the book value per share as 40. Apart from that, there is no information with regards to reserves or anything. So that's it. I think this is the answer for it. So this is like it's not tallying definitely. So whatever is not tallying, maybe there are some investment or some non-current assets. If it is not tallying, definitely there is some non-current asset which I have to take it as a balancing figure. So my balance sheet on this side it is 75 lakh. On the other side also it should be 75 lakh. So this figure will be a balancing figure, but obvious. It is 75 lakh minus 41 lakh 66 67 minus 15 lakh. Yeah, 18 lakh 33,333 is the balancing figure. Okay, so this is the final solution for the question. A lot of trickiness is there in this question, especially I just forgot to put that turnover was based on sales, and that led to a lot of issues coming up. Okay, now that's rectified and we have the correct solution. Now I'll be putting up this entire sheet of maybe around how much, it's around approx 50 pages. This entire PDF file I'll be uploading it on our portal, so we need not worry about that. Now let me see what are the queries that we have. This is done. MCQ number 11 from page number 3.58, chapter 3. Okay, page number 3.58. Okay guys, Page number 3.58. MCQ number 11. Okay, this one. Question number 11 or MCQ 11. How you got the net worth? Once again, how you got the net worth of 20 lakh? See over here, we had this ratio, no? Total liabilities to net worth is 2.75. So total liabilities will be actually total of liabilities, not the equity. Total of liabilities is long-term debt plus current liability upon net worth of 2.75. We took this and got the net worth to be 20 lakh. Okay, now coming to question 11. A company has average accounts receivable of 10 lakh. Yeah, now final question done. Has an average accounts receivable of 10 lakh and the annual credit sales is 60 lakh. Its average collection period is. Yeah, so that's pretty simple. First, you will compute the debtors turnover. Debtors turnover is 60 lakh divided by 10 lakh, which is 6 times. Now, debtors collection period will be 365 divided by 6. Simple. 365 divided by 6. 60.83 days. Pretty easy. MCQ number 9. Okay. In the following information, calculate the P ratio. P ratio is price to earning. So we need the market price per share. We need the earnings per share. So here we have the profit after 35% tax. This means we have a PAT of 2,67,000. We have a PAT of 2,67,000. From that we need to reduce the preference dividend. Now that preference dividend will be 9% of 3 lakh. 9% of 3 lakh, it means 27,000, right? That's 27,000. We have 2,40,000 as net profit for equity shareholders. 2,67,000 minus 27 will be 2,40,000. That's the net profit for equity shareholders. And then the net profit for equity shareholders divided by the number of equity shares. So number of equity shares is 8 lakh of 10 each. 8 lakh is the amount and each of the share is having a face value of 10. So 8 lakh divided by 10, that's 80,000. Number of equity shares is 80,000. So EPS is 3 and market price of equity share is 48. So price to earning is anyways 48 by 3, which is 16 times. That's MCQ 9 for you. Okay, in practical question 6, how to get the proprietary fund. Practical question 6. Okay, proprietary fund, practical question 6. Let me solve it. Again, we have the net working capital and the current ratio. We'll have to use those numbers first. Let me just quickly solve it without much of explanation going into it. So since current ratio is 2.5:1, therefore current asset upon current liabilities is 2.5. Therefore current asset will be 2.5 times of current liability. Okay, current asset will be 2.5 times of current liability. Now net working capital is 4,80,000. That itself is current asset minus current liability is 4,80,000. So 2.5 times of current liability minus current liability is 4,80,000. and 1.5 current liability is 4,80,000. So you'll get a current liability figure of 3,20,000, and a current asset will be that multiplied by 2.5. So you get a current asset of 8 lakh. Okay, so net working capital is done. Current ratio is used up. Now fixed asset to proprietary, and then reserves and surplus, and bank code is there. Okay, let me prepare the balance sheet first, and then we'll think of filling up the things. From this we have fixed asset, we have current asset, current liability, equity share capital, and reserves and surplus. So we have got current asset to be 8 lakh, current liability to be 4 lakh. No, that's not 4 lakh. Current liability is 3,20,000. Okay. Talking about some other number. Net working bank OD. Fixed asset to proprietary ratio. Again, fixed asset to proprietary. We have no other information. Reserves and surplus is the 3,20,000. Reserves and surplus is 3,20,000. Current ratio is used. Liquid ratio is just for the other purpose. Now, ideally, this balance sheet should tally. We have a information, we have a ratio, which is fixed asset to proprietary. Fixed asset to proprietary funds. This is the ratio available to us. Now, this is actually fixed asset upon equity share capital plus reserves and surplus. And this number is actually given to us as 0.75. And fixed asset upon equity share capital plus reserves and surplus of 3,20,000 is 0.75. So we'll have to solve it a bit by taking either of the values as x. Okay, so let us do one thing. Let me take this as x. Let me take the fixed asset as x. So if fixed asset is x, then equity share capital plus 3,20,000, that's 0.75. So x will be equal to what? 0.75 equity share capital plus 0.75 into 3,20,000. Which is 2,40,000. Right, so x is 0.75 times of equity share capital plus 2,40,000. So this is x minus 2,40,000 divided by 0.75 is actually equity share capital. So the equity share capital is x minus 2,40,000 divided by 0.75. So we get the equity share capital and fixed asset all in terms of x. But the thing is, sir, both of them should be equal. These two numbers should be equal, right? So on one side we have this total as x plus 8 lakh, and on the other side we have like x minus 2,40,000 upon 0.75 plus 6,40,000. These are the two numbers. So ideally they should be equal because assets should be equal to all the liabilities and equity. So we say x minus 2,40,000 divided by 0.75 plus 6,40,000 should be equal to x plus 8 lakh. Right. So now let's bring all x terms on one side. First, let's multiply throughout by 0.75 by taking the possibly LCM or mathematical operation. So 6,40,000 into 0.75. is 4,80,000. That's equal to 0.75x plus 6 lakh. Bring all x terms on one side. So x minus 0.75x is equal to 6 lakh plus 2 lakh 40 minus 4 lakh 80. That's like 0.25x is 6 lakh plus 2 lakh 40,000 minus 4 lakh 80,000. This is 3 lakh 60,000 guys. So x is how much? 3 lakh 60,000 divided by 0.25. Divided by 0.25, which is x is 14 lakh 40,000. Now what did we take x as? We took the fixed asset as x, right? Took the fixed asset as x. Therefore, fixed asset is 14 lakh 40,000. Now, equity share capital will be this figure, x minus 2 lakh 40 divided by 0.75. This is x minus 2 lakh 40,000 divided by 0.75. That's x is 14 lakh 40 minus 2 lakh 40,000 divided by 0.75. 14 lakh 40,000 minus 2 lakh 40,000 divided by 0.75. So equity share capital is actually 16 lakh. On this side you will have 16 lakh, this side you will have 14 lakh 40, and that will tally it. Right? So I think, is it clear how do we get the equity share capital in this practical question? The proprietary funds in practical question number 6. That was a tricky question because the ratio between fixed asset and proprietary funds was given with no clear distinction for each of them. So the only way to solve such questions is to prepare a draft balance sheet and equate the total of assets and total of liabilities. Okay. Got it? Tally at 22 lakh 40,000. Okay, correct. You got it tallied at 22 lakh 40,000. Any other queries? Any other questions you want me to solve? Any other practical question or MCQ guys? Tallied? Everything's fine? Okay, let's look at some analytical question like the one illustration we had. Possibly, yeah, illustration 5, where we do a bit of analysis about the certain performance parameters of the companies. So if you look at this company, ABC company sells plumbing fixtures on a term of 2 by 10 net 30. Now understand what is this 2 by 10 net 30. 2 actually indicates 2% discount. 2 indicates that we are giving 2% discount. By 10 means if within 10 days. So it is like you get 2% discount if you make the payment within 10 days. Net 30 means over a period of 30 days you have to pay. So regular duration given to the customers is 30 days. But if any one of them pays within 10 days, they will be given a 2% discount. Its financial statements over the last 3 years are as follows. So if you look at the numbers from 1819 till 2021, cash, accounts receivable, inventory, all these numbers are given. They say considering the opening balance of accounts receivable and inventory as 2 lakh and 4 lakh, analyze the company's financial condition and performance over the last 3 years. So we are already aware how to calculate the numbers. And in fact, in your practical life also, there will be softwares which will be giving you ready-made answers. Then what is our role, sir? What are we supposed to do? Our role is basically looking into the analysis. So let's look into some of the ratios that have been computed over here. Now, what ratio to be computed? My answer to you would be, you calculate whatever ratio you want or whatever ratio you can from all these numbers. From all these typical numbers, try to calculate all the ratios that you can. So you have like current ratio, turnover ratios, all of them you should try to calculate. Okay. So let's look at these ratios directly. Current ratio. Current ratio is 1.19, 1.25, 1.2. So what can we say about the current ratio, sir? Are there any typical problem? It's more of like a stable thing, sir, current ratio. It's not ideal. It is sub-ideal. Right? It's having a lower ideal ratio. So we go for another test. We are going in the same way as we have started our journey of ratio analysis. We go to the next level in which we see what is the acid test ratio or the quick ratio. So quick ratio is like 0.43, 0.46, 0.4. Does this quick ratio indicate a good situation or does this indicate a liquid situation, or is it indicating some problem? These quick ratios, are they indicating some really good situation or are they indicating some problems? So ideal acid test ratio, I have stated it should be 1. Current ratio is anyways okay, it's not 2, that's fine. So I just drill down into the next step and I found that the acid test ratio is 0.4, 0.43. And it's like there's a gradual decline also in it. It means company is short of the quick assets. We look at the receivables turnover ratio. Now here, the bells should start ringing. Sir, earlier I used to sell 20 times in a year. Second year I sold 18.7 times. Third year I sold 13.82 times. It means my turnover is falling. I'm not able to sell. I'm not able to make a repetitive sales to my customers. And moreover, if you look into the numbers, sir, sales numbers have reduced, but not your debtors. It means you're not able to collect your money on time. And that is indicated again in this collection period. If you see the collection period, 18.25, 19.52, 26.41, what does that indicate? That earlier you used to be able to collect within 18 days. Then it increased to 20 days. And now it is like 26.41 days. You're not able to collect your money easily and on a regular phase. Let's look at some more inventory turnover ratio. One is the inventory turnover. You see that it is 8.18 and then it has reduced to 6.11. That indicates that we are not good at selling right now because we are not able to pass on the inventory quickly. Or I can say I have piled up inventory. You see 4 lakh, 4 lakh 40 and 5 lakh 40. Ideally, as the sales has increased or reduced, the same pattern should follow even in the inventory. If the sales increases, you should maintain also a higher level of inventory. If the sales decreases, you should reduce your inventory. But that's not the case. Inventory has actually increased. Then long-term perspective. long-term liquidity or long-term solvency perspective, if you see debt equity ratio, you find it is 1.38, 1.4 and 1.61. So debt is increasing, debt equity ratio is increasing. So that indicates what? The company is taking more and more debt and it's not in a sound financial condition. Long-term debt to total capitalization. So as a proportion of total funds employed, long-term debt has been like constant. So we are not possibly borrowing for longer term, we are possibly borrowing for a shorter term. If you look at the GP margin, there's a constant fall, and this is a problem area. Your GP should not get reduced. If your GP is reducing, it means you are actually selling the products at a lower price, or maybe your cost of production has increased and there is no simultaneous increase in the sale price. So root cause of any problem of any business lies in the GP and the inventory. If you look at a GP ratio, that's like 20%, 16%, 13%, constant fall. And that is followed by even the net profit margin. Asset turnover has also reduced. Return on assets, that's been massive reduction from 21% return on asset. Now you are just generating 6% return on asset. So business is really suffering some problem. So what can we say about it? So current ratio and quick ratio is less than the ideal ratio. That's what we have identified, indicating that the company is not having enough resources to meet its obligation. Receivables are growing slower, although the average collection period is still very reasonable relative to the terms given. Inventory turnover is slowing as well, indicating a relative build-up in inventories. Increase in receivables and inventories coupled with the fact that net worth has increased very little has resulted in total debt to net worth ratio increasing to what would have to be regarded as on an absolute basis as a high level. Long-term debt to total capitalization has not changed relatively, coupled with the fact that the retained earnings of only 50,000 is made. Right, so long-term debt is not increased, but GP and NP margin has declined drastically. So the build-up in inventory and receivable has resulted in decline in asset turnover and coupled with a decline in profitability. So that's a ratio analysis that you undertake over here. So what suggestion, if you think what suggestion we should give to the company? From my subjective point of view, I will say the company to maybe increase the sale price, rationalize the discount that you are giving, or maybe try to work for cost reduction because your GP is suffering a lot. Try to collect money as early as possible from the debtors and try to maintain a lower level of inventory also. Right, so that's the suggestion which we can give from the performance of the company over the years. Now, this ratio analysis is not just limited to analyzing the company over the years. We also do it for comparing that company performance with that of the industry. Or industry means whatever business you are into. In that business, what is the ratio of the competitors? So for that, we have the next illustration. Again, I'm not going to calculate the ratios because we are very well aware how to calculate, but we are looking into what is the industry norm and what is our ratio. So industry norm is 2.5. Our current ratio is 2.67. We are good in that category. Receivable turnover wise also we are good. Inventory turnover wise, sir, we are bad. That indicates we are holding a huge amount of inventory. We are holding a huge amount of inventory. That is, most of our funds is blocked over there. Total asset turnover, we find as compared to industry, we are low. Net profit margin is also lower. Return on total assets, we are really good. Maybe this could be the reason we are having a lesser amount of fixed assets. Return on net worth is also lower. The equity shareholders are not sufficiently awarded. And total debt is this. So we can say that as compared to the industry, we are good with regards to the current ratio and receivable turnover. Inventory turnover, as I said, is poor because we are not managing the inventory correctly. We are holding a lot of inventory. Firm also has its net profit ratio and return on net worth ratio much lower than the industry norm. If you look at net profit margin, it is lower than the industry norm. The total debt to total assets is lower than the industry standard, which suggests that the firm is less levered. It means the company is actually less geared. The company may be geared to a better extent if the rate of interest is lesser than 7.19%. right? So therefore, it's as of now it's less risky, but if it can take debt and utilize the funds appropriately to generate higher returns, it will lead to better profitability. Okay, so these are the things that we have for ratio analysis. The types of question which you may get is straightforward ratio calculation. Secondly, preparing balance sheet and P&L. Thirdly, doing the analysis. Now, the more toughest part of this is the analysis part, because you need to write, you need to articulate your words and put it in the form of sentences and paragraphs. Right? So you also need to be analytical about those numbers. First thing, calculation of ratios is the easiest one. The second set of questions that we have, which are like preparation of balance sheet or P&L, somewhere or the other you get some sort of confidence that if my numbers are rounded off and the balance sheet is tallying, it's a correct answer, right? So that's what the holistic ratio analysis we have from the perspective. So that will bring this entire chapter to an end, and also our lecture for the day. Next session we'll start with a new topic. Okay, and then take it forward for the further discussion. Okay guys, fine, then let's just wind up for the day. If you have any queries, I'll just wait for a couple of minutes for your queries, otherwise we can call it a day. Any queries guys, you can put it in the chat box. In exam, high chance of the ratio calculation question. Ratio calculation, you can just refer the past exams guys. You can, past exam papers, you will get to know how the things are dealt with. You'll find a lot of questions in the form of like preparation of balance sheet and P&L. Any questions? Any queries, guys? No queries? All clear? Fantastic, guys. We'll meet up in the next class. Till then, bye bye and take care.